Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's set your agenda.
39th record of the year. Stocks are at another all-time high. Can the risk-on euphoria endure? A momentous week of central banks concludes. The BOJ leaves rates unchanged while mulling the next hike. And management shake-up. Nike jumps after veteran Elliott Hill swooshes out of retirement to step in as CEO. Good morning, Manus. Great to have you back.
Danny, good morning. Good to be back. A moment of reprieve in these equity markets. 39 records in a row, as you say. The question is whether it's exuberance or irrational exuberance. Bank of America, Hartnett is on the tape talking about bubbles again. Maybe you want to buy the dip in the price of bonds and the rise in yields. But for equities at the moment, 7 sessions in a row rising on the Russell. You're looking at the CIO for BMO still raising their year-end forecast to 6,100, another 9% to go. So for the moment, it is rational investing exuberance at the moment. To the bond market, the curve disinverted yesterday a little bit more aggressively, 14 basis points between the two at one juncture. The bond market seems less convinced that you needed 50 basis points than elsewhere. At the bottom of your screen, you're going to see dollar yen. Again, a cautious rhetoric from the Bank of Japan, Danny. They didn't want to run the risk of deja vu like they had the last time. So really, the Bank of Japan has time to assess the situation, seems to be the message. Danny, good morning.
Good morning, Manus. I think for the Fed, we really have to give Powell credit for the ability to do a narrative shift. You saw it in the equity market yesterday that you were talking about. Another all-time high, credit spreads back at the tightest since July. If Powell wanted to inject a narrative shift, that is one of soft landing, he succeeded in that. And we know for recessions, it's so psychological. So his ability to arrest this idea that we would be heading for economic downturns, he was able to do that, and now we have one where everyone is saying soft landing, so maybe it is recession avoided. And
it's interesting because the narrative was you want to sell the first cut in the equity. I mean, that was Bank of America,
yeah.
Sell the first cut. Here we are. It looks as if this 50 basis point cut is being accepted as being an insurance cut rather than a disaster recovery cut, so to speak.
Well, you look at something like FedEx earnings yesterday, for example. They were quite weak, and FedEx is known as this bellwether because it interacts with so many industries. And it's those types of corporate narratives that people have been calling for decisive action from the Fed. So now maybe you can look at a FedEx and not be as concerned of the global ramifications of it if you do have an aggressive cutting cycle.
And I think the narrative from FedEx is very clear, is that we're trading down from that super express high value ticket to something a little bit less aggressive. Let's talk a little bit more about these markets. We've got Mark Dowding, RBC, Bluebay, stepping in this morning. Looking back at the Fed's decision, he writes this, quote, "Instead of economic slowing, we might even witness a mini boom." And it's not lost on us that Powell may have quietly wanted to juice the economy as much as he can in the short term with November's election in mind. Mark, good morning. Good to see you this morning. You would suggest that this 50 basis point cut is a preemptive floor-setting measure. But then what did you take away from that word recalibration, which was so often used?
Yeah, look, from my perspective, it's there's a sense in which Powell had already achieved a soft landing. So ahead of this meeting, we'd already seen a situation where inflation was coming back to target. The economic trajectory has remained pretty robust. If you look at Atlanta Fed's nowcast, we're running at 3% for current quarter GDP. If you look at the economic surprise index, it's bounced 40 points from its lows in July. So the economy has already been doing fine. In my mind, there's a bit of a sense here of having achieved a soft landing. It's a bit of a case of, right, let's see how fast we can get this economy to go, notwithstanding a return towards more inflation pressures. So in a sense, I feel this is a Fed chair who's prepared to be a bit more experimental and wants to run this economy hot.
If he wants to run this economy hot, he wants to maximize growth, as you write about, Mark. What do you do with the dollar then? Because you have a hot running economy, but cutting? What do you do?
Yeah, so here I would say that, in as much as you've taken, we thought that recession risk was very low to begin with, but yet now you've completely kicked it off the table. And from that point of view, we may actually see an outcome where, because the Fed has played its hand and has effectively said that we're going to be there to cut aggressively. We want to do what we can do to boost growth. You may actually see that this actually ends up leading to fewer rate cuts than you would have seen if you'd have actually ended up with an economy actually slow down. So that's why I'd be looking at December 25 rate pricing 200 basis points lower than we currently are. And actually, I think that is unlikely to be realised. But when it comes to something like the dollar, on the dollar, I think in the near term, we've seen a move towards a weaker dollar and weaker DXY. But going forward from this point, if we continue to see robust growth in the US, which is our expectation, we actually think that the near-term data is going to be stronger, not weaker. If you see that, I think the dollar's weakness is likely to be short-lived.
You talk about an experimental Fed, but yet less than the 200 basis points that's been put on the slate. Is the risk that inflation becomes stickier and reasserts itself if they're really trying to juice this economy and they've gone for this front loading of 50 basis points?
Look, I think that risk on inflation is there. It's something that the Fed will be sort of thinking about sort of quite cleanly. I think the other thing to throw into the mix here is the US election. Were we to see Trump win, we think a Trump victory is likely to be inflationary through the lens of fiscal policy, through the tariffs, through moves on immigration that will tighten the labour market. We'd actually look at a Trump outcome as being inflationary and relatively bad for fixed income yields. And something that I've argued before is that when we look at the current economic cycle, we think this has got echoes to the 1990s, not the 2010s. What we saw in the 1990s, it wasn't uncommon to see situations where the Fed would cut rates by 50 or 75 basis points mid-cycle, only for rates to then go back up again. And the thing I'd say to you is that don't be surprised if you end up seeing an assertive Fed in the near term. Were you to see a Trump victory manifest, I wouldn't rule out the idea that you might get a rate hike at some point by the end of 2025.
So is it just load up on risk until that moment, Mark?
I think so, yeah. So for me, I like the idea that effectively the Fed's given you a bit of a put here. You want to chase risk assets. I actually think quite a lot of investors have been underinvested because they've actually been fearing economic downside. We see this in credit. We see a lot of money coming into credit funds, but actually a lot of credit investors have been sitting on the sidelines. And actually we might see a real desire to actually load up on risk in the short term that could actually mean that markets are quite bullish in the relatively near term. And we obviously saw that in the price action yesterday that came as no surprise to me whatsoever. I think it's certainly the rational interpretation in terms of what to be doing on the back of this Fed decision. And I think it was quite telling the fact that actually we saw bond yields actually a little bit higher than the Fed meeting, notwithstanding the fact that this was a dovish surprise. We've actually seen inflation break-evens move a little bit higher. Effectively, I think investors are looking at the action here and saying, yeah, you want to own risk.
And owning risk across the board has been there in equities and in credit. Let's just extend further on the bonds because we saw 2s, 10s, that disinversion, that steepening continue yesterday. Do steepeners play the main portion in this duration trade for you? Yeah,
so in terms of the curve trade, this is one that we have a lot of conviction in. I think the 2s, 30s is going to be moving steeper. I think part of this is longer term inflation uncertainty, but a lot of it is down to the fiscal trajectory as well. So this fiscal trajectory of travel, I think, is something that I think myself with a lot of bond investors have thought will end up steepening the curve over time. So I'm less focused on 2s, 10s, much more focused on 2s, 30s, if I'm honest.
Mark, you know what my most positive takeaway from this is, or one of them, is that we didn't even talk about the BOJ. The BOJ is boring again. Nature is healing. You love to see it. Mark.
Japan is boring, and they're not going to go in October now because of the LDP leadership election. Right. That could easily trigger a snap election. So we think probably January will be the month they go in Japan. So you're going to have to wait. And in the near term, that could actually see the yen actually a bit softer as we're seeing today. But if it goes up towards 150, you want to be buying it there. The direction of travel is still set in Japan. I just think you need to be patient.
Okay, and patient we will be, Mark. Always a pleasure to have you on. Mark Dowding of RBC Bluebay Asset Management. Let's get to some other top stories now that are trending on the terminal this morning. Warren Buffett's sale of Bank of America shares have now covered his investment. He is currently left with more than $34 billion of pure profit. Yesterday, a filing showed that Berkshire Hathaway had sold another $896 million of stock this week. That puts the total sum since mid-July, plus dividends since 2011, above $14.6 billion, and that is the amount that Berkshire spent building its stake.
Johnson & Johnson has boosted its offer to settle thousands of lawsuits by people who claim its baby powder gave them cancer. Now, the drug maker added over $1 billion to the offer, bringing the total settlement to $8.2 billion. That's according to people familiar with the matter. The company maintains its powders never caused cancer and were appropriately marketed.
Shares in Mercedes plunging this morning, down 6.7%. It cut expectations for its main cars unit on sluggish sales in China. It's just the latest sign of the struggle in the German auto industry. Both VW and BMW forecast pessimistic outlooks earlier this month. Mercedes CEO, for their part, is pledging to do whatever it takes to bolster returns.
Coming up in the show, Nike jumps pre-market as it brings the company veteran out of retirement. We'll bring you the story. That's next.
And later this hour, we're going to catch up with Mizuho's Steve Ricchiuto on potential inflation risks following the jumbo Fed cut. It's your Bloomberg Brief. Danny Berger and Manus Cranny back together again in New York. Let's get a check on shares of Nike this morning. They're extending gains, up 6.7% pre-market. The sneaker giant replaced the CEO, John Donahoe, and brought in a veteran executive, Elliott Hill. Told him time to get out of retirement and back into the CEO seat. It's part of an effort to return the struggling brand to its glory days. Let's discuss this with Andrea Felsted from Bloomberg Opinion, who covers the retail sector for us. I mean, Andrea, first of all, there's been so much CEO turnover this year for different companies. It's like a new CEO is the new buyback for corporate stocks. So why bring Hill out of retirement? What was happening at Nike?
I mean, this was really becoming inevitable. There was open discussion that he was going to have to go because the performance had been so poor. Stocks down 25% this year. It's really struggling against Adidas. So, it's surprising really that it took this long.
Andrea, good morning. Look, the Big Take wrote a cracking piece, which was that he peeved some of the relationships.
Is that the word they used?
I don't think that's the word they used, and I want to keep my job, so I won't be repeating what the Big Take actually wrote. But here's the thing: he's a man from Bain, and he knew how to operationally juice up the system to deliver on a timely basis. But he gave up shelf space, and that was the biggest error, they say.
Exactly, and also don't forget he came from eBay. He was as a tech person too, so he wanted to turn Nike into like a combination of a tech powerhouse and a luxury brand, moving out of many retailers to concentrate on selling through Nike's own stores and website, which is exactly the strategy that the luxury brands have. So on the face of it, it looked very good. The trouble was that the sportswear market is becoming much more fragmented. So when Nike pulled out of stores, there were many other younger, more exciting brands to take its place.
Andrea, just on that point, it is a more competitive market now. I remember a time when if you were buying sneakers for sports, it was kind of Nike, maybe Adidas. There wasn't a lot of options. Now there's so many, and kind of as you're alluding to, these more luxury brands like On, Brooks. You go out in New York City and you see them everywhere. Is this just a changed market that Nike's in? Can it really get back to where it was before?
I think this is a permanent change, actually, and I think this is, the shares have gone up a lot today, and I just wonder whether some of the challenges of getting its groove back are really being appreciated. Adidas is still very strong. There's been a real, fashion change as well, away from Nike's chunky basketball sneakers to these low-rise retro styles that Adidas specializes. Okay, fashion's very fickle. It can change again. But at the moment, it's not really showing any sign of turning around. And these cycles where Nike is in the ascendance or Adidas is in the ascendance can last a couple of years.
Well, Just keep your panda dunks on there, Andrea. They certainly were a winner for him at one stage when he was in the ascendant. Andrea Felstead on the very latest changing management seats at Nike. To a different story now. FedEx. The show's dropping double digits this morning after reporting worse than expected quarterly profit. The CEO, Raj Subramaniam, calling the quarter challenging as the shipping giant sees lower and slower business in the year ahead. Benedict Kamel is with us for the latest from Berlin. Benny, good to see you. Look, the key takeaways from this report is that, yes, we're shipping packages, but we're not paying a premium to do it. And that's the real canary in this story, isn't it?
Yeah, you're absolutely right. Good morning, Manus. Yes, as you say, people are still shipping, but they're having second thoughts about how they are shipping. There are principally two ways you can go about this. You can do the ground way, which takes a little longer, but is reliable, or you can do the express. And that's sort of the legacy FedEx business that they were built on historically, and that's the business that was really suffering in this latest report. People are having second thoughts about how they ship. They're moving away from the more lucrative express into the ground operation. So that's something that's fed through to the numbers and the outlook. So the company giving a more muted outlook for the year, saying that things will be slower. You're seeing it reflected in the stock price. And that has really spooked a lot of investors because FedEx is such a sort of bellwether for the industry and for the economy at large. And if people are having second thoughts about how they're shipping things, that's not a great signal. Just at a time when people are thinking that inflation was under control, that people were sort of getting a little bit more comfortable with their cost. So that sort of seems to pull people back a little.
To that point, Benny, if it's about a macro thing weighing on FedEx, what can they even do at this point?
They have already initiated a couple of steps. They are, for instance, integrating their ground and their express business. That's quite a change from the historic separation of these two assets. So the CEO's saying this will help us run the business more efficiently. They are also turning the cost screw. They are cutting some jobs. That's sort of what they can do at the moment. Whether they are able to do something on the pricing side is unclear. But right now they have a couple of steps that they're working on. It will be interesting to see how things go towards the back end of the year. Usually these businesses do well towards the back end when people ship more for the holiday season. So they might be able to recoup some of this in the next couple of months. But for the time being, the outlook is quite dim.
Benny, thank you very much. That is Bloomberg's Benedict Campbell. Manus, a quick check on the yen. It's a quiet market, maybe except for the yen. It is weakening this morning versus the dollar by about 0.8%. It's just an interesting one because the dollar's been weaker against most currencies because of those cuts. But again, with a boring BOJ, we're just looking forward to what happens next.
Be grateful for a boring BOJ. That's what I say.
Nature's healing.
Nature's healing. You're quite right. Some of those stock moves are pretty severe. FedEx down nearly 13%. We'll keep an eye on Nike in the pre-market. Coming up, we're going to discuss the other big headlines of the day. And it is a big day for Apple. Will Danny Berger get in the queue for a new iPhone? That is the only question on iPhone 16. This is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger, alongside Manus Cranny. Let's set your agenda.
It is the 39th record of the year. Stocks close out at another all-time high. Can the risk-on euphoria endure? A momentous week of central banks concludes. The BOJ leaves rates unchanged while mulling the next hike. And a management shakeup. Nike jumps after veteran Elliott Hill swooshes out of retirement to step in as the CEO. Danny, good morning. Swish that away.
Well, the hopium is alive and well, whether at Nike or these markets. As you say, we close at another 39th record. Small caps getting a huge boost, rallying for 7 straight days. That is their longest winning streak since 2001. Today, we take a break. We take a breather. We're down 0.2% for the S&P 500 future session. Maybe it has to also do with FedEx. A poor earnings and outlook from them. 2-year yields, not a lot going on here. We did see a lot of curve steepening. Curve steepest since 2022 at this moment of where we're at. 3.58% is your 2-year yield. Meanwhile, the BOJ stands pat. No fireworks, as we say, Manus. It was boring. Nature is healing the fact we got a boring BOJ. But because of that, no real hints as to where hikes are going to go. You are looking at a weaker yen this morning. Dollar appreciating 0.8, just about of 1% versus the yen because I feel like rounding.
You round away. Mark Dowding was with us a little bit earlier. He said, look, if you get back to 150, that's where you want to be a seller of it. But I think it's a question of the experimental nature of this Fed. That's according to Bluebay's Mark Dowding, Danny, and that's what he said. This is more like the 1990s than it is 2010. This is an experimental Fed. They want to juice this economy as much as they can. You can maybe put that down, maybe to a little bit of, getting out ahead of the politics. But either way, the risk is that you maybe end up with a little bit higher inflation and maybe not the full 200 basis points of cuts that is penciled in.
Yeah. Steve Ricchiuto has a really interesting view on this. I'm excited we're going to talk to him in just a moment. But I think all of this makes the dollar call so hard. You can say the Fed is cutting, therefore the dollar should be weaker. But at the same time, they're trying to maximize growth, which would suggest the dollar should be stronger. And maybe they won't get as many cuts, which also suggests maybe the dollar will be stronger. It is really confusing also because they're not going at the same pace as other central banks at this moment, too.
And the other aspect of the dollar is we're all driven by rates at the moment, but there is the RORO, which is risk off. In other words, if you get geopolitical risk, as is very live and very, very real between Israel and Hezbollah, if that escalates, what role can the dollar play in that? Because we have seen the dollar play that role of not perfect hedge, but a good hedge in geopolitical angst.
That is such an excellent point. I do want to get to that call from Mizuho Steve Ricchiuto. Here's what he said, writing in, quote, the potential inflation risks associated with an aggressive easing strategy were completely ignored, even as inflation is still well above target and the jobless rate remains historically low. I'm pleased to say that Steve joins us now. He is the chief U.S. economist at Mizuho. So, Steve, was 50 a mistake in this context then? And a Powell who basically said in so many words that inflation is vanquished?
Yeah, I mean, I think what the Fed is trying to do is to try to capitalize on the fact that foreign investors are interested in being involved in the U.S. marketplace as a safe haven, and that's driving down long-term yields. And they're reading that decline in long-term yields as saying inflation expectations are anchored. The reality is, because they're exploiting their credibility, they run the risk of losing their credibility. And when you lose your credibility, it becomes awfully hard to get it back. So there's a fine balancing act that they can run with for a while until it blows up. And the risks are that it will blow up, not that they will continue to pull it off. And going back to your discussion about the currency, the other key factor about the currency is inflation. You look at Europe, you can argue outside energy, Europe is in deflation. Japan, outside the currency, Japan is in deflation. China is definitely in deflation. We're sitting here with above target inflation, above trend economic growth, and this Federal Reserve wants to cut interest rates and has already effectively done it through forward rates, every bit as much as is included in the dot plots. So the economy is getting the benefit from that, even without them having cut rates.
And one of your key concerns is that we get a reacceleration of growth and therefore but the possibility of a reacceleration of inflation and quid pro quo, less quotes than is penciled in and that the market wants.
That's 100% correct. I mean, the reality of the situation is they have set themselves up, I believe, for only one risk, and that is they can't accomplish what they want because they've effectively already done it. So now we're going to see an economy that was running above trend, okay, with so-called restrictive interest rates. And now we're going to so-called neutral interest rates. Where will that above trend economy go? The answer is it's going to go stronger. And if you put monetary policy stimulus effectively in for 2025, and then you throw fiscal policy risks in, no matter who's elected in 2026, you're looking at back-to-back years of stimulus. That becomes a real inflation risk when we're already stuck at 2.6%. And this game of shadows, inflation's really at 2% because if we take out this or we take out that, it's really not there. Well, I got news for you. It's an index for a reason. And housing inflation is driven by the labor market. The mistake the chairman made, and I think the real fundamental mistake this Fed is making is they believe the labor market doesn't generate inflation. It does. And he said that. He said the labor market is not the cause of the inflation. It is. People that are making money, people that are employed, people that are doing well, rent homes, they buy homes, they drive up housing inflation, and that's why you have an inflation problem. There is a supply issue as well, but that ain't going anywhere. So you're allowing the demand side to continue to stretch the supply, and that's just going to keep that component of inflation hot.
What does that mean in terms of the balance of risks? Because as we're talking about, Powell made it very clear, almost as if this is not a dual mandate central bank.
Correct.
That this is a central bank focused on the labor market.
Correct.
But what of the weakening in the labor market? What of concerns of FedEx this morning saying that they're having poor earnings, the bellwether company? What of those types of risk? What is the balance that the Fed should have been striking?
When you look at a company like Federal Express and you look at the position they're in, clearly there was pricing issues that came about. I know this from having to ship, product around the world when I'm going to different places for presentations. Okay, it's gotten expensive. So the reality is, if I send it out a week earlier and it goes through a more traditional channel, company saves a lot of money. No excuse there, but their loss is somebody else's gain. And therefore, it doesn't affect the overall macroeconomic environment. This is a pricing problem, and that's a problem they're going to have to address. They're trying to address it through cost cuts, which is good, but the reality is, in this environment, they're not going to shed an enormous amount of workers because they don't have an enormous amount of workers to shed. And the economy in general is dealing with a labor shortage. So the reality of the situation is we're still at below full employment. Cutting interest rates makes no sense.
It's amazing. Everybody else was coming in criticizing the Fed for being behind the curve. Here you are just smacking them because of what they've just done. But can we double down on this? Because you would say no matter who wins this election, you're going to have more inflationary stimulus next year fiscally. Therefore, what's the risk of a material U-turn by the Fed, which happened to them before many decades ago? What's the risk of having to pause or even raise rates next year?
That becomes the risk that they run. There's no doubt about that. As I said earlier, I think there's only one-sided risk to what they've done. And that is, as Larry Summers says, they can't accomplish what they want to. And quid pro quo on that is they can't accomplish what they want to. Do they have to take some of it back? And that depends. Since they're using forward rates, okay, they may never have to change the Fed funds rate. All they have to do is change the rhetoric, change the dots, and the markets begin to adjust incredibly fast. That's the point of this. Forward rates is the policy tool these days, not the Fed funds rate. The Fed funds rate is too political. It's too sticky. It's like trying to get people to go into the discount window to borrow. You can't do it no matter what you try. Same thing's true with the Fed funds rate. It's too political, attracts too much attention. Just look at the ridiculousness we went through going through in terms of this rate cut environment. However, they had already accomplished it as of Jackson Hole, with drawing the line in the sand at a 4.3% unemployment rate, which incidentally reminds me more of Arthur Burns than Paul Volcker.
Okay. The dynamic of the Fed, because the Fed speak we had heard coming into this, if you put Chair Powell's Jackson Hole speech aside, you wouldn't really be certain what they were going to do. Powell somewhat showed his hand at Jackson Hole, that he was interested in 50. But what you come out with is Powell being able to corral everyone except for Mickey Bowman around 50. I just wonder what you make of that dynamic, because we had just heard from Waller before the blackout period saying, I could be convinced, but he wasn't there. What do you make of Chair Powell's ability to get everybody there?
I think the problem is they did so much politicking. There were so many people coming out. News media went out and found everybody in the world who would say yes, and they didn't put anybody who would say no on until the day of. And so, it's an incredibly difficult position for these people to be in from a political standpoint, and this becomes the problem with the Fed funds rate. It is so political. And that's why forward rates are what they're really using to drive policy. And they can be very flexible with forward rates. And this is what Ben Bernanke is going out to people like the Bank of England and saying, this is what you're supposed to be using in terms of setting monetary policy. And they did it. He decided to do it unilaterally, or somewhat unilaterally, I would assume, at Jackson Hole. And he started the whole process. This is his mess. He's going to have to clean it up at some point.
And that transmission mechanism is live in the mortgage market. Rates down almost at 6%. You say use this moment to reduce your duration risk. So any pop in yield, you want to shift, lighten up the load.
Yeah, I think the thing that makes the most sense is when you look at the shape of the curve, and we're slightly positive here. We're a whole 10 basis points.
10, 13.
The reality is, if I go into the bill space, I've still got a nice yield in bills, and I don't have any loss of capital risk as I go forward in here, especially if things start to go against them. And if you look at the claims data yesterday, you look at the continuing claims data, you look at what's happening in terms of the labor market front-end developments, you're seeing a situation where the economy's not going the path that they want. Inflation's stuck at 2.6%. The economy's healthy. We're going to be at 3% growth. We're likely to be stronger in the fourth quarter of the year. Surprising, not surprising enough. And the net result is, we could be in a very different situation by the time we get to Christmas.
Okay, Steve, good to get your take. A robust Robust discussion there on the Fed. That's Steve Ricchiuto. Coming up on the show, we will look at the key issues in the White House race. Of course, it's housing. Diane, CEO of American Land and Title Association, is next. Context Matters on Bloomberg. It is Bloomberg Brief. I'm Manus Graney with Danny Berger in New York. We're 45 days out from when the American nation heads to the ballot box. And one of the key issues at the top of voters' minds, it's housing. According to a survey by real estate brokerage Redfin, Gen Z ranked housing affordability as the most important issue of all. This is, of course, on the back of the Fed launching its policy easing cycle and anticipation of further rate cuts to come. Diane Tom is the CEO of American Land and Title Association. She joins Danny and I this morning. Dan, good to have you with us. Let's just talk about the housing market. Mortgage rates are now back at a one-year low. We're in a Fed easing cycle. The risk in this housing market is that we see a furious unleashing of animal spirits. Is that the major risk that America faces now in the housing market? Let's start there.
Mortgage rates in anticipation of the rate cut earlier this week have already to come down. So we've started to see a lot of movement in that area. We have a lot of refi happening. We have some housing constructions moving forward. But the reality is the affordability piece, supply has not shifted. So there's so much. And as you alluded to, both candidates have sort of addressed this at a high level. But that's really where we're going to see a lot of different things coming through.
And in terms of that, Diane, I mean, there's been a lot of proposals thrown out there. For Trump, it's about immigration, saying that he's going to solve it because there's going to be less demand, because he's going to deport people, have less immigrants in. Kamala Harris is talking about this idea of trying to boost tax incentives to get home builders, and as well as giving first-time home buyers incentives. Diane, it's a lot, and there's a question as to whether any of this will actually be passed. But are you hearing anything that actually could be effective in lowering prices and reinvigorating the housing market?
You know, so much of what happens in the housing industry is local. So the fact that it's being talked about at the federal level is helpful, and the fact that they're introducing ideas. But really where it's going to happen, particularly when it comes to regulatory burdens, which is as much a critical piece of keeping houses from being built as the affordability piece and the supply issue. So much on the supply issue really goes back to 2007 and 2009. We have not built, there's millions of houses that are not in the market that should be, that normally would have happened. So it's going to take some time, but based on as things are starting to move with the rates going down, lending, the folks in the construction industry are going to be able to access capital, we should start to see things move. It's just not going to happen really quickly.
Let's just build on that, Diane, because Business Week, Bloomberg Business Week, did an interview with Trump where he talked about bringing permitting down by nearly 50%. We'll be doing that. We'll be bringing the price of housing down. How realistic is a proposition like that you can reduce the permitting? Is that one of the biggest headwinds to housing?
It is. I mean, the regulatory environment is very, very difficult for anybody wanting to build in this. So being able to have access to cash, but also being able to work with the local municipalities and having the private investment involved is really, really critical. Hopefully, the fact that, again, both candidates are talking about it and have recognized the true issue of what's going on will allow that to continue to be addressed at the national level, but also in geographic areas. Because, again, so much about real estate and housing is very, very local, like most things.
Diane, you mentioned that after 2007, the problem stretched back to then of when housing didn't come back on the map. And after the housing crisis, we had a lot of people just leave the industry, workers, different players. And then when the industry comes back, all of a sudden you get rate hikes from the Fed and mortgages are high and then it freezes. To what degree is what we're witnessing in the housing market a structural problem with not the right setup and players there who can actually build and get supply back onto the market?
Danny, that's a really good question. Most people who are in the real estate housing industry, it's a very cyclical industry. So people are prepared, and they have to be prepared to ratchet up when, like in our case, like refis are starting to come back. And so people have been preparing for that because it's been a long 2 years since the interest rates have gone up after the pandemic, which was unprecedented. And we're never going to see anything like that again. Right now, about 60% of all mortgages are probably 4%. And that's not going to happen. Our hope is that with the rate cuts and the Fed indicating that they're going to continue, that maybe we get somewhere by the end of 2025 close to 5.5. But for the most part, I think we're not going to see rates like they have been. So the alternative is the supply and housing affordability is not going down. We all know that costs have gone up and things continue. So I'm not so much sure it's a structural issue as it is the economic winds and a whole host of historical events that happen that we still haven't gotten back to where we need to be able to house the people who want to be in homes.
Look, there's no doubt about it. It's the supply side of this equation. You can see it in Harris's tax incentives that she's potentially offering to organizations. But I want to talk about federal land, and this is where there's probably some bipartisan support. Trump proposes opening federal land to build new homes. But if that has bipartisan support, what are the guardrails? What's the most important guardrail around that needs to be implemented to make the policy real?
Yeah, no, that is such a great question because honestly, at the end of the day, every day we're working on a bipartisan approach on our issues because again, housing, we always say we're the party of title insurance, but we're not. Housing is a very bipartisan issue, and there are so many issues that are out there that do get support on both sides. And when it comes to the election, as you mentioned, Danny, as important is what happens on Capitol Hill, because that's where these policies are really going to be executed. You know, whether it's through your point, Manus, on the federal lands, that would happen through an executive because of the Department of Interior. There's Indian land. So, and then there's a lot of local states. So there's so many components to this that it really needs to be worked
Diane,
and addressed
if I
on a
can jump
bipartisan
in on that local level, because I know you've mentioned it a few times. I mean, there's still a lot of NIMBYism, not in my backyard, still a lot of local red tape. What changes that?
You know, I think having access to cash, I think the builders, what we're seeing right now, the existing home sales are not moving because, again, most of those folks are rate locked. And it's going to take a lot for them to want to get out of those 2 to 3% mortgage rates. But in terms of supply, it's the new houses that are selling. It's the folks that you talked about, the Gen X and the Gen Z and the millennials. We have a huge market of folks who want to be in homes. It's going to be a location issue. Places like the Southwest and others where there's a lot of land and they can build in a much more, in a much more cost-effective way, you'll start to see that. But in some of the places in the Northeast Corridor and others, it's going to be very difficult because, you know, the land just doesn't exist.
Yep, and those locked-in mortgages, as you say, Fed cuts, there's not enough to change any of that. Diane, really wonderful to speak with you this morning. Thanks for joining us so early. Enjoy your weekend. Diane Tom, the CEO of American Land Title Association. Coming up, we're going to set you up for your trading day on this Friday. This is Bloomberg. It's your Bloomberg Brief. Danny Berger and Manus Cranny in New York. Let's get you set up for your trading day on this Friday. Early and absentee voting will begin in Minnesota, South Dakota, and Virginia. Plus, we're going to hear from ECB President Christine Lagarde. She will speak at 11 a.m. Eastern. It's also Triple Witching Day, which will see over $5 trillion of options and futures fall off the board that move over. And Manus, I mean, we talk about triple witching all the time, and I guess like volumes are higher. It's never that big of an impact. To be honest, right? Like volumes kind of go up and maybe some weird actions, so a little bit of volatility, but like
it's a fairly chunky number. Let's see whether it delivers any volatility. I know you're sort of quite meh about the whole thing. But anyway, let's have a look at some of the stocks that we're watching. FedEx dropping as the profit and revenue forecasts are cut. Look at that. That is a colossal tank, down 13%. Lennar misses expectations for orders as rates challenge the buyers. And Nike replaces the CEO, veteran executive Elliott Hill. Let's get a little bit more on the CEO changes at Nike. Andrea Felsted is with Bloomberg Opinion. Andrea, all change at the Wish. Swish,
exactly.
Rather than wish.
Exactly, yes. This looked inevitable, really. Nike had been underperforming. Donahoe's strategy wasn't working. It had, exposed Nike to lots of new competitive upstarts. Sales had suffered, and it really needed to get new sneakers onto the market and reconnect with retailers. That's what he will have to do.
Okay, Andrea, let's keep an eye on that. We've got that on the move. Andrea Fell said Bloomberg opinion. We've got Nike on the move, and we've got FedEx on the move as well. As we are trading down in your packages that you're sending, the price that you're actually spending. I hope you're going to spend a lot of money sending me my Christmas package by express post. Or is it Thanksgiving?
Yeah, we got to get through Thanksgiving first. I am going to London next week, so maybe I mail you some, I don't know, Christmas cake. I'm trying to remember what things exist in London.
British marmalade.
You want Marmite?
Marmalade.
You want marmalade in the mail?
Yeah.
I feel like I can find something better for you, Manus.
Oh, you can send me something exciting in the mail. There's no problem with that.
Some Hermes cuffs or something like that.
Oh, I'd like a new piece of Hermes. Go with the tie. Should we talk about markets?
Let's talk about markets. Markets save us. You do have equity markets weaker this morning. Bonds, a little changed.